The average American with $50,000 in savings will lose $12,847 in purchasing power this year alone. And most people have no idea it's happening. Picture this. You check your savings account every month. The number stays the same. You feel secure. You think your money is safe. But here's the brutal truth nobody talks about. Your money is shrinking every single day. While you're sleeping, while you're working, while you think your cash is growing. The average savings account pays 0.45% interest. Inflation in 2026 is running at 3.2%. That's a real loss of 2.75% per year. On $50,000, that's $375 in year one. But it gets worse. Way worse. Because inflation compounds too. Over 10 years, that $50,000 loses $31,200 in buying power. Today, we're diving deep into the hidden cost of cash. I'll show you exactly how much you're losing. More importantly, I'll show you 3 strategies to fight back. Let's start with the math that'll shock you. Sarah thought she was being smart. She had $75,000 sitting in her Chase savings account, making a whopping 0.45% interest. She felt responsible, conservative, safe. But let's run the real numbers. Her $75,000 earns $337.50 per year in interest. Sounds terrible already, right? But wait, it gets worse. Inflation in 2026 is 3.2%. That means her money needs to grow by $2,400 just to maintain its buying power. She's losing $2,062 every single year. In purchasing power terms, her account balance should show $72,937.50. But the bank still shows $75,337.50. Here's where it gets crazy. The government counts that $337.50 as taxable income. At a 22% tax bracket, she owes $74.25 in taxes. Now she's down to $263.25 in real gains, against $2,400 in inflation costs. Her net loss? $136.75 per year. But this is just the beginning. Most people don't realize inflation isn't just about groceries getting more expensive. It's about your money becoming weaker. Think of it like this. In 1995, $1 could buy what costs $1.89 today. Your dollar lost 47% of its value in 28 years. The same thing is happening now, just slower. And banks love this system. They borrow your money at 0.45%. They lend it out at 7.2% for mortgages. That's a 6.75% spread on your cash. They're making $3,075 per year on your $50,000. While you lose money to inflation, nobody talks about this part. The opportunity cost is even more brutal. Let's say you kept $50,000 in savings for 5 years. Your total after taxes and inflation? About $43,200 in today's buying power. Now imagine you put that same $50,000 into the S&P 500. Even with market volatility, the average annual return is 10.2%. After 5 years, $81,200. The difference, $38,000. That's the real cost of playing it safe. But here's what really hurts. This isn't just about investment returns. This is about your future lifestyle. That $38,000 difference could be a new car, a down payment on a house, 2 years of groceries, your financial security literally evaporating. Why do people keep money in savings then? Fear, mostly. Fear of losing money, fear of market crashes, fear of complexity. I get it. The 2008 financial crisis scared people. But here's what they don't realize. Keeping cash is the guaranteed way to lose money. At least with investing, you have a chance to win. Banks have convinced us that savings accounts are safe. But safe from what? Not from inflation, not from opportunity cost, not from slowly getting poorer. Here's strategy number 1 to fight back. The emergency fund optimization. You need 3 to 6 months of expenses in cash. Let's say that's $15,000. Don't put it in a 0.45% savings account. Use a high-yield savings account paying 4.8%. That's $720 per year instead of $67.50. Still losing to inflation, but losing less. Strategy number 2 gets more aggressive, the cash ladder system. Keep 1 month of expenses in checking, keep 2 months in high-yield savings, put the rest in a conservative investment mix, 60% stock index funds, 40% bond index funds. This gives you liquidity for emergencies, but growth potential for everything else. Strategy number 3 is for the bold, the investment-first approach. Keep just 1 month of expenses in cash. Everything else goes into diversified investments. Use a taxable brokerage account for flexibility. This maximizes your growth potential. Yes, there's more risk, but inflation is risk too. The risk of getting slowly poorer. Let's talk numbers on strategy 3. Same $50,000 example. $5,000 in high-yield savings for emergencies. $45,000 invested at 8% average returns. After taxes and fees, you net about 6.5%. That's $2,925 per year in real gains. Compare that to losing $2,136.75 in a savings account. You're $5,061.75 better off each year. Over 10 years, $65,000 better off. That's not just money, that's freedom. But wait, what about market crashes? Here's the reality check nobody gives you. Yes, markets crash. The S&P 500 has crashed 26 times since 1950, but it has recovered 26 times too, and reached new highs. Your savings account, it crashes every single day, silently, invisibly, but permanently, through inflation. At least market crashes end. Inflation never stops. Here's the psychological trap banks exploit: loss aversion. We fear losing $1 more than we value gaining $1, so we choose the guaranteed small loss over the possible big gain. Banks market this as being responsible, conservative, safe, but it's actually the riskiest financial move you can make. Guaranteeing yourself will get poorer. Now here's where most people mess up. They go from 0% stocks to 100% stocks overnight. That's not smart. That's gambling. Start small. Move 10% of your excess cash to index funds. Get comfortable, then increase it gradually. Dollar cost averaging works. Invest the same amount every month. When prices are high, you buy fewer shares. When prices are low, you buy more shares. Over time, you get the average price, and the average price of the S&P 500 always goes up. Here's what $500 per month looks like. Instead of keeping an extra $6,000 per year in savings, invest it monthly in a total stock market fund. After 10 years at 8% returns, $91,524. The same $60,000 in savings, about $52,000 after inflation. Your $39,524 is ahead. That's real money, life-changing money. But here's the twist nobody expects. The biggest risk isn't market volatility. It's not starting early enough. Time is your most powerful asset. A 25-year-old investing $500 monthly until retirement at 8% returns, $1.4 million. A 35-year-old doing the same thing, $679,000. 10 years of delay costs $721,000. That's the price of keeping money in savings too long. Your future self is literally paying for your fear today. The math doesn't lie. The system is rigged against savers. Inflation is a hidden tax. Banks are the house, and the house always wins. Unless you change the game. Stop playing their game. Start playing the wealth-building game. Here's your homework. Calculate your real savings account loss right now. Take your balance, multiply by 2.75%. That's what you're losing this year. Feel that pain. Use it as motivation. Then pick one of the 3 strategies I shared. Start this week, not next month. Your future self will thank you. If this opened your eyes about the hidden cost of cash, smash that like button and subscribe for more money truths they don't want you to know.